Most investors are making a critical mistake with their dividend yield strategy. They're waiting 90 days between paychecks when they could be getting paid every 30 days. Here's what I discovered when I analyzed the top monthly dividend ETFs. The difference isn't just about timing, it's about psychology, tax efficiency, and building real passive income. Think about this for a second. Traditional dividend stocks pay you 4 times a year. That means you're going 3 months between each dividend payment. 3 months of wondering if the market crashed, 3 months of watching your portfolio bounce around, 3 months of no income generation. But monthly dividend ETFs flip this script entirely. Instead of quarterly anxiety, you get monthly confidence. Instead of 4 payment dates to remember, you get 12 opportunities for passive income. And here's the kicker. Some of these funds are delivering dividend yields that would make your grandfather's pension jealous. I'm talking dividend yields of 12%, 14%, even 15% annually, paid out every single month like clockwork. But before you mortgage your house to buy these funds, we need to talk about the trade-offs, because nothing in investing is free. These monthly dividend ETFs use something called covered call options to juice their distribution yield. And that strategy comes with a very specific cost. Let me show you exactly what that cost looks like, because most investors have no idea what they're giving up. When you buy Apple stock directly, you own all the upside. If Apple goes from $180 to $220, you capture that entire $40 gain. But when you buy a monthly dividend ETF that holds Apple and sells covered call options against it, you're capping your gains. The fund might sell call options at $200. So when Apple hits $220, you only get the gains up to $200. That extra $20 per share goes to whoever bought the call option from the fund. In exchange, you get the premium from selling that call option. That premium becomes part of your monthly dividend. This is the fundamental trade-off of covered call option strategies. You're trading unlimited upside for steady income generation. Now let me break down the 4 funds that are dominating this space right now. SPYI, JEPI, QQQI, and OMA. Each one targets a different type of investor. Each one has a different expense ratio, and each one will impact your portfolio allocation in a completely different way. SPYI is the elephant in the room. $3.6 billion in assets under management. It tracks the S&P 500 and delivers a dividend yield of 12.57%. That's more than triple what you'd get from the actual S&P 500. But here's what most people miss about SPYI. The tax efficiency is actually incredible. Because of how they structure their covered call options, 60% of your gains get taxed as long-term capital appreciation. Only 40% gets hit with short-term rates. Plus, a huge chunk of SPYI's monthly dividend comes as return of capital. That means you're potentially deferring taxes on a big portion of your income generation. Think about this from a practical standpoint. If you're in the 24% tax bracket, short-term gains cost you 24%. Long-term gains only cost you 15%. That tax efficiency can add up to thousands of dollars per year on a large portfolio. But there's a catch with covered call options. When the market rockets higher, you're capped. Looking at the performance data, SPYI has underperformed the S&P 500 during strong bull runs. You're trading capital appreciation for monthly dividends. The expense ratio is 0.68%. That's reasonable for an actively managed covered call option strategy, but you need to factor that cost into your total return calculations. JEPI takes a similar approach but focuses on large-cap stocks instead of pure S&P 500 exposure. $39.82 billion in assets under management. This is the grandfather of monthly dividend ETFs. It's been around long enough to prove its strategy works in different market conditions. Dividend yield of 8.04%. Expense ratio of just 0.35%. The lower expense ratio is attractive, but 8% dividend yield isn't going to change your life overnight, unless you're sitting on serious capital. To generate $5,000 per month in passive income from JEPI, you'd need about $745,000 invested. That's not exactly accessible for most investors. JEPI holds 112 different stocks across various sectors. 17.16% in finance, 13.12% in electronic technology, 12.58% in technology services. The diversification is solid. The market exposure is broad, but the distribution yield is conservative compared to the other options. QQQI is where things get interesting. It tracks the NASDAQ 100 and delivers a dividend yield of 14.57%. Think Microsoft, Nvidia, Apple, all the tech giants you already know. But instead of waiting for their tiny quarterly dividends, you're getting monthly income from covered call options. $1.69 billion in assets under management. Expense ratio of 0.68%. Here's the beautiful part about QQQI. Over the last year, the total return actually beat the underlying NASDAQ 100. The NASDAQ 100 returned around 13%. QQQI delivered positive total return when you factor in monthly dividends. You got higher income and competitive performance. But remember, this fund only launched in January 2024. 1 year of data doesn't prove anything. We haven't seen how QQQI handles a real bear market. The NASDAQ 100 can be volatile. Technology stocks can swing 20 to 30% in a matter of weeks. When you add covered call options to that volatility, the results become unpredictable, especially in fast-moving markets. QQQI's top holdings read like a who's who of big tech. Microsoft at 8.78%, Nvidia at 8.51%, Apple at 7.70%. If you're bullish on technology long-term, QQQI gives you monthly income from the companies you already believe in. But you're also concentrating your risk in one sector. OMA is the wild card in this group. It's not tracking an index at all. Instead, it mirrors Warren Buffett's top 20 holdings from Berkshire Hathaway. Think of it as a monthly dividend version of investing alongside the Oracle of Omaha. Dividend yield of 15.30%, the highest distribution yield in this entire comparison. But OMA only has $207.6 million in assets under management. That's tiny compared to the others. Expense ratio of 0.95%. You're paying almost 1% per year for the privilege of copying Buffett's homework. OMA's top holdings include Berkshire Hathaway at 9.93%, American Express at 7.76%, Apple at 7.64%. These are quality companies with proven track records. But here's the thing about OMA. Buffett doesn't buy these stocks for monthly income. He buys them for long-term capital appreciation. When you overlay a covered call option strategy, you're changing the entire investment thesis. You're taking companies designed for growth and turning them into income generation vehicles. That might work, but it's not what Buffett intended. The covered call option strategy makes this possible. But it also caps your capital appreciation when these stocks run higher. Here's what nobody talks about with these monthly dividend strategies. The psychological impact is massive. When you're getting paid every month, you stop obsessing over daily price movements. Your portfolio allocation feels more stable, even when the net asset value bounces around. But you need to understand the math. Monthly dividends from covered call options aren't magic. The money comes from somewhere, either from the underlying dividends of the stocks in the fund, or from selling call options against those positions. When you sell a call option, you collect a premium. That premium becomes part of your monthly dividend, but if the stock price goes above the call option strike price, you miss out on those gains. This is why these funds typically underperform in strong bull markets. They're designed for steady income generation, not explosive capital appreciation. Let me give you a real-world example. Say you invest $100,000 in SPYI at the beginning of the year. With a 12.57% dividend yield, you're looking at about $1,048 per month in passive income. That's $12,570 per year. But if the S&P 500 goes up 25% that year, you might only capture 18% of those gains due to the covered call options. You're leaving $7,000 on the table. Was the extra income generation worth missing out on $7,000 in capital appreciation? That depends on your goals and timeline. If you need the monthly income to pay bills, the answer is yes. If you're building long-term wealth, the answer might be no. So which fund belongs in your portfolio allocation? If you want the most diversification with solid tax efficiency, SPYI makes sense. 507 holdings across the entire S&P 500. Expense ratio of 0.68%. Proven monthly dividend track record. The distribution yield of 12.57% is attractive without being too aggressive. And the tax efficiency benefits are real. If you're bullish on technology and want higher dividend yield, QQQI could work. But remember the limited track record. The 14.57% dividend yield is compelling, but the sector concentration adds risk. If you want to follow Buffett's playbook with monthly income, OMA offers the highest distribution yield, but you're paying premium fees and taking concentration risk. The 15.30% dividend yield is the highest in this group, but the 0.95% expense ratio and small asset base are concerns. If you want the most conservative approach, JEPI gives you the lowest expense ratio and longest track record, but also the lowest dividend yield. The 8.04% dividend yield might not move the needle, but the strategy is proven and the costs are low. Here's my framework for deciding. First, what percentage of your portfolio are you dedicating to monthly dividend ETFs? If it's less than 10%, go with JEPI for stability. The lower dividend yield won't matter much in a small allocation. If it's 10 to 20%, SPYI gives you broader market exposure. The diversification and tax efficiency become more important. If it's more than 20%, you better understand exactly what you're getting into. These aren't set-it-and-forget-it index funds. Second, what's your timeline? If you need income generation right now, the higher dividend yields matter. If you're building for retirement in 20 years, total return including capital appreciation matters more. The covered call options trade-off becomes more significant over longer periods. Third, what's your tax situation? In a taxable account, the tax efficiency of SPYI and QQQI becomes crucial. The return of capital component can defer taxes for years. That's real money saved. In a retirement account, you can focus purely on total return and dividend yield. Tax considerations don't matter inside IRAs and 401ks. Fourth, what's your risk tolerance? QQQI has the highest sector concentration risk. OMA has the smallest asset base and highest fees. SPYI offers the best balance of risk and reward. JEPI is the most conservative but offers the lowest income generation. The monthly dividend revolution is real. These funds are attracting billions in new assets for good reason. But they're not replacing your core portfolio allocation. They're enhancing your income generation strategy. The question isn't whether monthly dividends are better than quarterly. The question is, which monthly dividend ETF fits your specific situation? And now you have the framework to make that decision. The data, the trade-offs, and the strategic considerations. Your passive income strategy starts with understanding these fundamentals. From there, it's just a matter of picking the right tool for your goals.